Is $1 million really enough to retire on? We'll look at the typical income from a $1 million portfolio to help you find out what lifestyle you could have. The term millionaire was first made in 1762, and at the time it represented an incredible amount of wealth. Nowadays, we know it means far less due to inflation. But what type of lifestyle can we realistically afford with this amount? We'll look at the following types of investment portfolios to compare the income on various sources based on market data. Firstly, the Vanguard S&P 500. Secondly, the Vanguard Lifestrategy 60% stocks and 40% bonds. And finally, the 25% in the Vanguard S&P 500 and 75% in a rental property in the US. We won't examine pensions or government Social Security benefits because they vary based on government policies, employer contributions, etc. Firstly, let's look at returns from the 100% S&P 500 portfolio, as shown here. The S&P dates back to 1927, however, it's only from 1957 that it tracked 500 stocks. We can see that from 1957 to 2024, the average return per year is 10.26%. It's important to bear in mind that if you enter in the market at one of the high or low points as shown here, you'll likely experience very different average returns over the short term. A popular rule is to withdraw 4% of your portfolio annually because it has been tested to maintain a portfolio over the long term while accounting for inflation at 2 to 3% plus capital gains taxes. Common strategies for retirees include buying an immediate annuity, which turns a lump sum into a monthly income for the rest of their lives. An annuity is a contract between the buyer and an insurance company. The buyer of the annuity pays a lump sum or consistent payments over time in exchange for the insurance company to make regular payments to the buyer. Another common way is to invest in a portfolio that is ideally well diversified across stocks, mutual funds, and bonds to help reduce risk. The major advantage of an immediate annuity is the fact that it offers a fixed income that's guaranteed for life. Here are some key things you need to be aware of with immediate annuities. Annuities typically pay more when interest rates increase. Monthly payments will be affected by your life expectancy. Women usually live longer than men, so they typically receive a smaller annuity check from the same balance. Life insurance companies sell them. They are not counted as investments, but rather contracts with insurance companies that help protect you against outliving your money. The principal and interest balance are amortized with fixed payments for the retiree. The major disadvantages of an immediate annuity include: a major disadvantage is that owners are limited to their monthly income. You can suffer from illiquidity because the invested cash is typically locked up for an extended period of time, commonly referred to as the surrender period. If someone wants to withdraw money within that period, it will often take on a penalty fee. Depending on the product, these periods can sometimes be more than 10 years, and surrender fees can be over 10%. Secondly, the income is taxed at normal income tax rates, not long-term capital gain rates. For example, a high-income earner in the U.S. could pay 37% income tax as of 2024. However, the maximum capital gains tax is 20%. Also, if you buy an immediate annuity when interest rates are low, you will likely take on large upfront fees with lower monthly payments that will be relatively high in comparison to the fees. You must consider whether the peace of mind associated with reducing the risk of running out of money outweighs the benefit of having complete control over your money. Annuities are complex and sometimes very costly, as many individuals purchase these products without understanding all the terms and conditions. Make sure you research all the fees and any other costs involved. Another popular way of generating retirement income is through a portfolio, where 4% is typically withdrawn every year plus the rate of inflation. For example, if the retiree has $1 million, they would withdraw $40,000 for year 1, and if inflation was 3% for the year, they would take out 103% for year 2, which is $41,200. The main reason why 4% is chosen by most is because when you add inflation, it's still less than the average S&P 500 return, which usually averages around 10% per year. It's essential to bear in mind that most retirement portfolios would be less risky than 100% in the S&P 500, which would help reduce portfolio volatility and drawdown periods. However, decreasing the portfolio risk by diversifying would also reduce the returns. Another option for investing in retirement comes from the popular Vanguard Lifestrategy 60% equity fund, which consists of 60% equities and 40% bonds. As you can see from the chart below, since its inception in 2011 to 2024, the fund has returned 242% over 13 years, which is 18.6% per year on average. It's important to realize that the last 13 years have been exceptionally good for the US stock market returns, and this trend may not continue for the following 13 years. Our final retirement plan is to have 25% in the Vanguard S&P 500 and 75% in a rental property in the US. For this example, I've used the average rental yield in 5 major US cities as shown here. The rental yields are for New York, Los Angeles, Chicago, Houston, and San Diego, so you can get a good idea of what to expect. Overall, the combined total is 31.7%, with an average of 6.3% as of July 2023. It's important to remember that the rental yield is gross, meaning it's before taxes, repair costs, agent fees, ground rent, and any other costs. The net yield is usually around 1.5 to 2%, lower on average than the figures shown here. Also, we need to add in the capital appreciation of U.S. property, which, from 1992 to 2024, has been around 5.5% per year. When we add the average rental yield plus the average capital appreciation, we get 11.8% before any taxes, fees, and any other costs. If we take 11.8% for 75% of the portfolio and add it to the 25% of the portfolio in the S&P 500, we get 8.9% plus 2.5%, which is 11.4% on average. It's important to bear in mind that the return from U.S. property is less volatile than the S&P 500, and it provides diversification to your retirement strategy. This brings us to the significant disadvantage of traditional portfolios. There's no way of knowing what returns to expect over the short term, and many retirees could panic sell during a stock market crash. Interestingly, according to the Pensions and Lifetime Savings Association, or PLSA, a comfortable retirement that includes 2 holidays yearly would require £37,300 per person, or £54,500 per couple in 2023. The amounts may seem low, but it's important to remember that in retirement, people have no commuting costs, little or no mortgage, no student loan debt, and can cut accommodation costs by downsizing. Additionally, depending on other factors, you might be entitled to a state pension. Unfortunately, 89% of the working age population is not on track to reach the PLSA's level for a comfortable retirement. When planning for retirement in the U.S., being aware of Social Security and Medicare is crucial. For anyone born from 1960, the full retirement age is 67. Therefore, if you take Social Security benefits before this age, you'll get reduced monthly benefits through retirement. Also, it's important to be aware that you'll only receive the maximum monthly benefits from over the age of 70. If you're interested in finding out more about retirement planning and how to avoid the top 5 common 401k mistakes, check out this video here. It's a good idea to plan ahead enough money to cover your retirement from 65 to 67 without Social Security income so you can collect the full benefits. With Medicare, you can avoid paying health insurance. However, it doesn't cover everything and it's not free. If you're eligible for Social Security benefits when turning 65, you'll be enrolled in Medicare Part A, which covers your hospital expenses. Additionally, you'll get Medicare Part B, which covers your visits to a doctor. Another factor to bear in mind is that it can often be harder to get credit in retirement. Therefore, you'll want to have enough cash savings for unexpected expenses. Consider having an emergency fund while considering potential costs for housing, medical care, dependents, etc. Hey, if you liked watching this, check out more videos here next. Please consider subscribing and click that like button because it helps. Cheers!